Hey guys, welcome back to another video. In this video, I'll be talking about inflation, interest rate cuts as usual, because these things, the situation is still going on and it can affect the mortgage rates of your house, your cars, your gross, and even buying groceries and so on, every expenses and how you live your life, and even your investments, which investments are, very important. So in the course of what the Fed decides to do with these interest rates, it could change the course of your investments as well. So I want to talk about this topic. So what I'm going to talk about is what is going to happen moving forward, and this is what I have learned. So this is kind of like educational for me as well, putting out what I've learned on YouTube. And now to my first point, which is the latest inflation report and what it tells us. So the latest inflation report was released on September 11th, and headline inflation, which is CPI, is now at 2.5%, which is the lowest it has been since 2021, which is a good thing. It doesn't mean that inflation doesn't exist, doesn't mean that prices are not going up anymore. It just means that it's going up at a slower pace comparing to 2 years ago. But policymakers like Feds, they don't normally look at headline inflation as the main thing. They like to look at core inflation. So core inflation is now at 3.2%, which core inflation normally exclude volatile categories, which is like food and energy. So that would still be at 3.2%. However, there is progress, so that's good. So in the past year, the Fed has been aggressively increasing interest rates, right? And now we're being able to see the progress that was made because of those rate increases, which is a good news, of course. And now to my second point, which is why is the interest rates coming? So we gotta tie back to what is the Fed gonna do next. The Fed is most likely going to have an interest rate cut on September 18, which is the next Fed meeting. And we can just take the stats based off the CME Fed Watch tool, which says that there's an 85% chance where there's going to be a 0.25% rate cut and a 15% chance of a 0.5% rate cut. So this is based off voting of people deciding. And so most likely there's going to be a 0.25% rate cut, and it's literally just 3 days away. So it is most likely going to be a rate cut based on the newest inflation report. It says that it is safe to go. So that's probably what's going to happen. But why is there going to be a rate cut? There's two reasons. First of all, inflation is getting lower, and second of all, there are shown signs of weakness in the labor market. What does this mean? It means that the labor market is weaker. There's a lot of unemployment because people don't have money. So they're going to decrease rates so that it is easier to borrow money. So more people are going to spend money. Encouraging people to spend money makes the economy have more activity, right? There's more wealth interaction and so on. Because of the money circulation, it would indirectly make the economy better. And because of this, it can prevent a recession, which they don't want to force the inflation to be so low that it could make the economy really bad. So they can actually prevent recession by making people spend more. But in turn, it could also spark inflation again, which that is just depending on how they balance it. And now to my third point, which is how does this affect you? How does this interest rate cut affect you in your personal life, in your financial life? Well, it can affect you, for example, when you want to buy a house. When there's low interest rates, people tend to buy a house more because you don't want to pay that much interest in the long term, right? However, because there is a lower interest, it could also drive up demand, which is I just said you want to buy in a lower interest rate, right? Driving up demand could also drive up prices, which is how inflation could also be revived after a rate cut. So even though you may need to pay lesser interest, which is come by percentage, the overall price might actually go up. Similarly, if you're saving in a bank account, if there's a lower interest rate, you'll realize that you're earning less because of the interest rates being lowered, right? But if you are in debt or you are in a mortgage or anything, like credit card debt, then this might benefit you in some way. So basically, even though the interest rate may seem low, actual price of the thing might actually increase, but however, if you're actually in debt, that might actually be at your benefit. But of course, at the same time, if you borrow too much money because the interest rate is too low, you might just end up not being able to pay it back because you feel like, oh, interest rate is low, I'm just gonna borrow, and then eventually, oops, I can't pay it back, which is also a bad thing. But the low interest rate also affect the stock market as well. If the low interest rates make the stock market go up a lot, because people want to invest in an alternative instead of just putting the money in the bank, because the bank clearly has low interest. Now they invest in the stock market, right? But the stock market goes up. What if you just end up overvaluating the company, which you don't know much about? If you invest in stocks, you must know your stocks. But at the same time, even if you do, right, even if it's a famous company, what if you overvaluate? It could turn into a bubble and then it bursts, and then you also could mess up your portfolio and stuff like that. So you have to keep an eye out and then keep the balancing act of your financial wealth as well, and try to work this lower interest rate to your advantage. And now to my fourth point, which is inflation versus deflation. So lately, right, we've been talking a lot about inflation coming down, but actually some headlines are actually worried about deflation, right? They're talking about how inflation is actually going to come down so much it could turn into deflation, where price actually go down, not just slow down. And this could be a problem, right? At first glance, it could be good, right? Because prices go down, who wouldn't want that? Who wouldn't want prices to go down? Except that might not be the case, because if prices actually go down, it shows that there is a slow market, a weak market actually. So indirectly indicating the fact that a lot of people don't want to spend money. When they don't want to spend money, it could affect the jobs and businesses to have a weaker and crumble, because businesses need to provide the employees, right? And then if businesses don't have enough money because of deflation, then they'll collapse, and then jobs will collapse as well. So if deflation becomes a real risk, you know what the Federal Reserve is going to do? That's right, they're going to print more money, because printing more money is the easiest way for quantitative easing. And they're going to, of course, if this becomes a serious issue, they're going to put more money into the market. Basically, they put more money into the economy to make sure that deflation does not happen. But why do they don't want deflation? Because the Fed cannot afford the country to have a less stronger GDP. They cannot afford GDP to become weaker, and they cannot afford any stagnation in the country. That's why they must solve this problem if this becomes a serious issue. But the ironic part is that we've been fighting inflation for so long, but we have to intentionally bring it back if deflation becomes a serious issue. And now to my fifth point, which is the long-term outlook. So what's going to happen? Most likely the Fed's going to cut rates next week, actually in 3 days or 2 days by the time this video is posted. And after that, there's probably going to be a series of cuts throughout 2024 and then 2025 onwards, and probably beyond as well. We'll see how that goes. But that's probably what's going to happen after inflation has come down. But that's not all that's going to happen. The Fed's going to do quantitative easing. However, quantitative easing plus so many rate cuts will probably end up creating a cycle. You know how when people say, oh, normally an inflation cycle happens once every 10 years? Well, that cycle's obviously so broken at this point. It doesn't apply anymore. So in this case, I think if after the rate cuts, if they initiate quantitative easing as well, this will probably lead to them having to deal with inflation again. However, we won't feel the effects immediately. Probably throughout 2024, we will have lower inflation throughout 2025, but quite certainly in 2026, in my prediction, don't have to take my word, just a guess, my guess, that 2026 probably have inflation spike up again, possibly even faster than before, because of the amount of rate cuts and quantitative easing. But yeah, and the conclusion is basically in this video, the Fed has increased rates, lower rates, in just a short period of time of 2 years, right? 2-3 years, and this is going to make a ripple effect in the economy. It will cause an effect like inflation to spike up again. Eventually, we'll probably have a stable market, stable economy for probably 1.5 years, and then inflation is going to come back. Or in the period of that time, you'll face problems with interest rates that would spike inflation, like the housing market, the stock market, and so on will be affected. However, so basically what I'm saying is that we'll probably have a period of time where it's stable, but after that, we'll probably have a period of time where we'll have growth in the stock market as well, and then inflation will probably come back because of how broken the economy is right now. The cycle is kind of broken, and what the Fed plan to do, like quantitative easing, is also going to cause that as well. But this is just my prediction and just my way of looking at things, if I just look at it from my eyes. So I hope you enjoyed this video, and I hope you also appreciate my opinion as well. I just want to know that this is just educational purposes for myself, and if you want to learn, continue this journey with me, then continue watching my videos as well. I will appreciate it if you like and subscribe, and I hope to see you in the next one. Bye.